lived through a big storm, you probably know that the time to defend yourself is before the event happens. Along those same lines, being prepared for unavoidable market downturns means setting yourself up while the skies are clear, because storm clouds, they can come on pretty quickly. The past several days have seen a lot of market turmoil, and there are a number of different causes, not the least of which the U.S. Treasury yields hitting multi-year highs. This has caused some agita among equity investors, and last week it created a couple of the sharpest two-day retreats in equities we've seen in months. You've also got trade wars and high stock market valuations and maybe some slowing of growth in international markets. So this brings up the question, what can you do about it? Well, if you've been following us for any time now, you know we're going to tell you got to have a strategy and have a bucket strategy, right? And a bucket strategy helps you allocate your portfolio to short-term, mid-term, and long-term buckets. Short-term buckets provide you with a portion of your portfolio that you can use for current needs, while your mid-term monies are allocated for times to either replenish your short-term needs bucket or take opportunistic plays and invest into your long-term bucket, which is the third bucket, which is long-term investing for 10 years or beyond. But the key is given all this market volatility and how long we've seen this bull market run, what should you do now with your bucket strategy? Well, we talk about this with our advisors and relay the message to you and through these videos and our clients is we should be considering right now taking some money from our equity or our long-term buckets and building up a nice healthy bucket 2. Bucket 2 is really the core part of the overall bucket strategy because you can go either way with this money, right? You can replenish your short-term bucket for income purposes, or you can use it opportunistically to buy into the stock market when stock market values are lower, right? So you got to make sure that you have an ample amount in your bucket 2. But then that begs the question, well, how should we be investing our bucket 2 today? Typically speaking, the bucket 2 portfolio, usually investors prefer a balanced allocation of stocks and bonds. Well, 60-40 mix. Well, the problem with that is because interest rates are rising, you're seeing some pullback in the bond valuations, which is a drag on the overall performance. While at the same time, you've got stock market valuations, at all-time highs, right? So now, what do you do with your balanced bucket or your midterm bucket if you're concerned? Well, you still got to have some liquidity, but what about putting some principal protection strategies inside your bucket number 2? So consider thinking about a trigger strategy for your bucket 2. A trigger strategy is one where if an index, not including dividends, right? If the index is positive just 1 penny, you'll get the trigger rate of return for that year. However, if the index is negative, your principal is guaranteed and you will not lose any money, right? So consider a trigger annuity type strategy for your bucket 2, along with maybe some other principal guarantees like certificates of deposit or even multi-year guaranteed fixed rate annuities to complement your balanced bucket portfolio. So now I would look at this and consider your bucket 2 more like a ladder, right? The higher up the ladder, the more risk you might be taking. So that balanced portfolio might be closer to the top of that ladder. Remember back in the Great Recession, balanced portfolios fell roughly 30 or so %, right? So that's a long ways to fall off the ladder. While at the very bottom rung, you're only stepped up just one little rung, you could probably take that fall. And so principal guaranteed strategies, CDs and money markets, maybe even fixed rate annuities might fit there. The trigger annuity strategy fits somewhere in between. So consider that as an option for bucket 2. But overall, we want to start building up our bucket 2, making that a little bit bigger, reducing your long-term growth bucket, and that'll give you the opportunity, if a market does pull back, to make the decision whether to help yourself buy low and hopefully in the future sell high.